We think about it is, and I said this right at the start, you want to be in countries that are that you're relatively certain of what the policy is. Business will work it out. If we know what the rules are, and as long as there are rules and a rule of law to enforce them, we'll figure out how to invest and where to invest. So we can absorb a tariff here, a tax rate there, a particular incentive to stimulate tech in that place or not in the other place. But we require certainty. So for me, in terms of long-term structural investing, I want a place that has that and where capital can flow relatively freely. The challenge for non-Chinese investors now looking into China is, yes, the stock market may be relatively cheap and one can trade that, but to be a very long-term structural investor is quite difficult if you're not certain what the rules are going to be if you're not Chinese and if you're from overseas. So what I think you're seeing at the minute is the relative attractiveness of India. Geopolitically we can get into, but even economically, where there's certainty of policy and there's some structural reform going on here and the whole move to digitalization and bringing more people into the net, it's a very attractive place to invest if you were doing a straight one-to-one comparison, not just on scale, but on certainty and on terms of rules under which you can operate and invest for the long term. As investors, we can trade everything. That's all jolly good fun. But what really helps us is not day-to-day and second-to-second trading, but being able to commit capital for the really long term and then trade around the margins. But you want to be long and right and then trade around the margins. What you don't want to do is have to keep going, oh my goodness, they're going to shut the gates on capital flows, or they're going to start saying they don't want foreign companies, or they're going to start saying healthcare should no longer be a private sector business. These are things not happening in India, but they are the risk in China. So for me, structurally, India is more attractive long-term. China's, of course, massive and will be the biggest global economy. How you play that is much trickier without certainty.
Okay, this is also a thought actually a lot of other investors echo, and I often find this, most foreign investors, at least we speak to, seem to be saying that we are good to invest in China as a tactical opportunity. There might be a bounce and we'd want to capture that, but because we've burnt our fingers over the last 10 years, the Chinese markets have gone nowhere, paltry returns and equities, so big money is not going back to China. So are we just extrapolating? Are we prisoners of, a long period of outperformance? Are we underestimating China's ability to come back and score in the next decade? Will that be a mistake?
I think there's a lot in that question. We've been investing for a really long time, and we've been investing in China for a really long time, and India, and in different ways and at different times. And you've always had the issue in China, and at some points you're concerned about having that in India or in anywhere, in the UK. Is it a level playing field with the state? Am I going to be competing with the public sector, and am I going to be able to play in the right way? And for a long period of time in China, you were always concerned, was subsidy going to SOEs? Was there a problem with SOEs? You invested private capital for the long run. Could you make a good return on it because you were going to get structurally beaten by the domestic investor or the domestic party? So that was a big concern for us in terms of China. I think that concern still exists. I think what is going to happen, though, the sheer numbers of people, the sheer scale of the market, means that the market will over time grow. Yes, it'll have its moments where you have a population trend that isn't so fabulous at the minute. They'll fix that. Whether it's 25 years away or not, that is going to get fixed. It's big. There's lots of people. There's going to be lots of consumption. So I don't think you can afford to ignore it. It is true that one has to take, I would say, a much more tactical view of China today, and you can, because the markets are liquid enough, than you might have done 20 years ago when you said, I've just got to be in China. I mean, there are people that are doing just fine, foreign investors in China. There are sides of the financial sector that are growing. It's just, it's more tempting to be tactical.
Sure. You talked about Indian markets and some of the allure, but somehow over the last 6 months, we've seen such accelerated pace of foreign selling. It just seems to be unrelenting. Nearly $26 billion has moved out of Indian equities alone in the last 6 months. Now, we have a long structural story, there is certainty with respect to policy, then why this level of exodus?
Yeah, because everybody's not a structural investor. Unfortunately, or fortunately, depending on how you want to look at it, India is regarded as up there as one of the most significant economies in the world in the future over the next 10, 20, 25 years. And it is a natural choice for big global investors to look for bigger markets to invest in. If we just leave the domestic side, the domestic investors out for the minute. So what happens is when people get excited, they look for a big market to play in. And if you think about it, what you're seeing now, the last 5 or 6 months of foreign capital disappearing from India, the equity market in particular, the daily traded equity market where they can change their minds, was really about two things. It was about, had India run too far, and based on very long-term numbers, you could say that the level of PE, et cetera, was high in terms of a 25, 30-year period where it should have been, particularly in the small and mid-cap space. But it was also people going, well, hang on a minute, I'm an emerging market investor with a global fund. It's about relative value. And China had been slammed for so long. And the big way we've outperformed in equities over the last 4 years, to be honest, was massively overweight India 3 or 4 years ago and underweight China. And a lot of global investors have switched that trade. They've said China is so cheap. The monetary policy bazooka in China was fired in September. They are getting serious about the fiscal. Eventually you will get some level of growth coming back. If the state is underpinning property asset values by sucking them up from the private sector, you're hitting a floor. And once you do that, the chance of the natural demographic growth, which hasn't been great, comes back. China is just a whole hell of a lot cheaper, and India got so expensive in relative terms globally, not just against China. So there has been a lot of switching out of India into China, not a lot of which is not permanent capital.
Okay. Now, a lot of money that has come into India, at least in terms of fund flows, I'm saying in terms of fund collections, has come through India dedicated funds, not through the emerging market funds post-COVID at least. Now, do you see any time in future, now of course we are underway a fairly serious correction, at least if you just look at the post-COVID period, this is the first time we are seeing a more than 10-15% correction in the market. Do you see India becoming an asset class by itself? How far are we from that point?
Yeah, I do. I think that will definitely happen. All markets
By when?
A week on Friday. I'll be here Thursday. I'll take the hat around, give me the money, we'll invest it, you'll do great. Which is a basic rule, of course.
No, on a serious note, like 3 years, 5 years, what would be your bet?
Well, I think it depends on your perspective. I mean, and a lot will depend on what happens geopolitically. And it's been very interesting seeing the evolution since 20 of how some of the larger institutional investors invest globally. It used to be when we went and spoke to the biggest investors, be they pension funds, be they sovereign wealth funds, they said, oh yeah, EM, I should buy that, here's some money. Or maybe I won't give you the money, I'll give it to some other idiot, but here's the money. They didn't really get into the nitty-gritty of what they were buying, and they just, we'll leave it to you to pick China over India, over Russia, over Brazil. And that was one of the biggest frustrations for my colleagues as we built local businesses, where our longer-term bet was two things would happen. The domestic markets would get much bigger, and that would drive the machine, but also global investors would start to say, I need to pick the winners. But while you had it's ironic that while you had all the benefits of globalization, you had a bit of a blurring at the edges of the foreign investor picking who to win. So yes, structurally investing in terms of manufacturing happens country by country, but the financial pool of capital tended to be, I just buy EM. So we spent 20 years trying to say to people, yeah, but there's a time you might want to buy Mexico and not Brazil, and a long time trying to persuade people to do that. The geopolitical stress of the last 3 or 4 years, ironically, has started some of the biggest investors thinking, wait a minute, I've got American pension funds are now asking us to pitch to manage money ex-China. We want EM ex-China. And as soon as they start thinking that way, that means that they start thinking, well, hang on, if I don't want China, maybe I do want something. And what we've seen over the last 18 months is we're having increasing conversations. We have an Indian team who are very good at what they do, and they're being asked to go and speak to the Americans, the Europeans, and those in Asia, talk about India-only money. And when people start thinking about India-only fund investing and India-only separate account investing, that immediately tells you you're getting to the point where you're a market of your own. Is it a black and white switch on, switch off? No. But is it happening over the next 5 to 10 years? Yeah, I think any serious global investor will have to have money in India, more or less, from 5 years' time, maybe from today. I mean, we do.
Right. Now, Indian markets have been actually the worst performer this year. Amongst emerging markets, I think it's the third worst. There was only, I think, Indonesia and Taiwan, which have lost about 11%. We've lost about 8%. Now, in one way, it is good because valuations become cheaper. A lot of the foreign investors who are probably waiting on the sidelines might want to get in. But how do you think realistically foreign investors look at this when you see this level of volatility?
How do I think they look at value here?
Yeah.
I think.
How do you view the volatility in India at this point in time?
Yeah, I think if I look at my fund managers who manage global books, it's quite interesting. You see a lot of investor psychology through the people you work with. I think they've all been looking for a moment to buy the market. I think they felt it's expensive, and they thought it was very expensive, and then they thought China was cheap, and so they reduced their massive overweight to India, and they started to buy China. At the same time, the institutions I mentioned before that are starting to look at single countries and trying to pick winners that have already started to pick India are saying, yes, it's all too expensive, but yes, I'm in here. And if my allocation is this, it goes up and down around the margin, but structurally I'm committed, even in liquid product, they're all looking at a chance to buy. I think they're saying, we're getting questions from the US through Europe, through Asia, is it time to buy India now?
Right. I asked this question to Howard Marks also, and I'm going to ask this question again to you. What is your sense of, what are the chances that the US economy will actually slip into recession this year? Because government job cuts, potential inflation coming back, all of these look like not very happy things.
I think there's definitely a reasonable chance. Recession, obviously, depending on, let's say you define it as 2 negative quarters of growth, which is a traditional definition. That would be a lot. I think it's going to depend. This is what I talked about earlier about policy. If you have too much policy uncertainty, the first thing investors do is get out or do nothing or sit in cash. And there are a lot of investors in the US already sitting in cash, and there are a lot of foreign investors who say, I've got way too much US dollar. What on earth do I buy? Where do I go from here? And the longer policy uncertainty continues and people aren't sure of the direction, I think the chances are that the consumer in the US listens, hears and feels that, and then whether they're losing their job or not, they find the guy down the road lost their job, and they just do less. So the things to really look for are activity levels in terms of consumer construction and all that kind of stuff. You know, employment is really a lagging indicator for all of that. It's really what do you see in terms of the front end, in terms of what purchasing managers are thinking. All that kind of inflation, again, is a lag. It'll follow all of that. So I think there is a chance that there's already, the conversations we're having in the US at the minute, there's definitely, if you're talking to people in the Midwest, it's, well, I'm just going to wait and see what I do for now. And yeah, I had cash, and I was going to buy long bonds now because I thought duration rates were going to keep coming down. Maybe I'll just wait for the minute. So I think what you're getting is a little bit of a pause into, you had the election, this is a pro-business president, everything's going to be fabulous, markets went crazy, everybody bought AI, isn't that fabulous, the world's over-changing, and now people go, oh, wait a second. And at the same time, you've got the suspicion that, like every other technology advance, the second level advance is to reduce the cost of it dramatically. So as the first producer, you make a lot of money initially, but then you have massive competition. Doesn't stop the adoption, it still becomes a widespread thing, but it gets steadily less profitable for the manufacturer. So where do I see that in terms of the US? Do I see recession? Probably not. But I think what we will probably not get is a lot more rate cuts, despite the fact there'll be massive political pressure. Because if you're the central bank, if you're the Fed, you should be taking a longer term view. And although the president might try and lean on you, this Fed president, he's got 18 months to go. He's going to try and do the right thing. So I think you're probably it's going to be a little bit wait and see. You might get one other cut. But then the real question is, do you get rate increases? And it's totally going to depend on inflation. But what I do think is the Fed will take a wait and see between 2 and 3% inflation. If inflation doesn't pop through 3% and get going, I think they're going to do nothing. And if it doesn't pop through 3%, I think they'll resist some kind of recession. And also, we just don't know how inflation these tariffs are going to be. There are tariffs that are not that inflationary. There are tariffs that will impact some countries, not others. Services tariffs are not there at the minute, which is a good thing for India. Services are a big deal for India, and tariffs are not there, which means the relative cost still stays pretty cheap. Also, India's producing some things that are pretty hard to tariff equal to start producing them in America. So there'll be winners and losers of the tariff stories. So I think recession is possible. I think it's not likely in the next 3 months. I think interest rates will sit in quite a narrow band.
Okay. What is your sense on fund flows into emerging markets? Do you see a huge reversal this year, or is that wishful thinking?
Well, what we saw from 22 was American capital panicking and hiding behind the sofa, so exiting pretty rapidly. So we saw a lot of negative flow, through 23, 24. That's slowed down quite dramatically. We're now seeing, as I say, people starting to say, is it time for me to buy emerging market equity and fixed income? Let me think about value. What's supported that a little bit, which I think has slowed the flow down, is people just are so long the US. I mean, if they had a US equity position, shut their eyes, it went up 20% for a while. What's also supporting it a bit, I think, is they're seeing absolute performances pretty good within EM equity and EM fixed income. I mean, EM fixed income was the best performing bond market the last 3 and 5 years, despite outflow. So I think we're seeing investors sort of take stock. If I look at our client base, our best clients have been with us a really long time, and they have a strategic allocation, and they bring it up and they bring it down. So they're nervous, they brought it all down tactically through 23, 24. So they're still in the game, but they're much smaller, and they're open to be reallocating to us. That's true in equity and in bonds. And if anything, the US is very much an equity market, so they prefer equities. So the first thing that will be a flavor of the turn from the US will be people buying equities. We're seeing a tiny, tiny bit of interest in the mutual fund space, particularly in things that are seen as friends, looking for single country product or for product where it is friendshoring type story, not something that's seen as a competitor to the US.
Will it be necessary for Fed rates to come down for, a reverse flows to start to happen?
No, I don't think so. I think the key thing is positive spread.
It's just that it's perception.
I think it's a perception. I think what, again, like most things in life, when people feel there's some kind of floor or some kind of range that's established, then people start looking for the next place to go.
Incrementally.
Yeah, I mean, when everything's in one direction, people just tend to jump on the bus. But once things have settled down, people start looking backwards at numbers and start trying to look forwards. So I think we're in a position where we get a little bit of stability in terms of US policy, and people say, figure out, is geopolitics going to literally blow me up? If it isn't, then I can start investing properly. And as I say, in terms of flow, we saw big outflow in 23, less so in 24, less so now.
Sure. One last question. What's your take on the dollar and gold? Gold for a large part was seen as a hedge for the dollar, but both of them have been pretty much moving in tandem.
What was the first thing? Gold and?
Dollar and gold.
Oh, the dollar and gold. Yeah. Well, gold is obviously a particular asset class that people here are very expert in. I'm not. So I think I don't really have a strong view in terms of dollar and gold, to be honest with you. I think the dollar is expensive. I think the dollar needs to weaken. I think rate cuts are unlikely to be the driver for weakness from here. I don't think we're going to see massive rate rises, but just in terms of absolute flows, I mean, the US is now a massive, massive debtor to the rest of the world. I talk to our clients in Asia and Europe, and they say, we can't buy any more dollar assets, we can't buy equities. So I think that's quite interesting. It's an EM positive story, but I think it's also, ironically, I think we're going to have a euro positive story. The euro is going to have to use interest rates to support issuing a lot more debt to rearm. So I think actually, ironically, euro, which has been a bit, oh dear, what's happening with growth, I think the currency might see some support over the next year or so. I think EM will be part of the beneficiary of that. A lot of EM countries in that euro ambit.
Okay. Mark, just one last question. What is Ashmore's, how large are you in India? How bullish are you in India? And how do you look at India right now as a tactical market, or is this, do you exit at all? How is that portion managed?
Well, India is one of the economies that we've decided we want to be a long-term investor in. What does that mean? Ashmore invests in bonds, equities, and private capital. We do private debt, private equity. We're trying to be in any asset class where we think we can be good, and in a place where we can be good at it. That depends on people, and depends on the demographic being good for the economy. We want the bigger economies generally, and rule of law. So all those things, India ticks the box for us. We've been investing here for donkey's years, longer than we care to remember. It's one of the economies that we decided we wanted a local business. So we didn't just want to bring in global capital, which can flip from India to China and vice versa. We said to ourselves, wait a minute, India is an economy which, given the growth dynamic, we ought to be able to build a domestic business where we're appealing to domestic institutions and domestic retail investors to say, hey, we can manage your Indian money for you better than you can. We believe we found a group of financial professionals. I think we've got a great team here that can basically do a better job than the market and do it consistently over time. So for us, India's a place where not only do we like to invest bonds, equities, and alternatives from offshore, we also want to do that from onshore. So we're building a domestic business, we're building a domestic asset management business, and I see India as one of the 5 or 6 economies where Ashmore will have a big Ashmore domestic business, unrelated to the global business, loving it, kissing it, feeding off it, sharing flows with it. But I think it's a place where we're going to build a big domestic asset management business. That's one of our targets.
Sure. That's all we have time for, Mark. It was absolutely incredible talking to you. Thank you so much.
Great. Thanks for your time. Thanks for listening to me. Thank you, everybody.
All right. Thank you, Mark. Thank you, Mahalakshmi. Now, while discussing India's road to a $10 trillion market, the foundation of its journey lies in how businesses are scaling and growing. Let's hear now from a finance expert on how financial planning, credit solutions, and microfinance can further be enhanced using AI and digital transformation and its role in India's growth landscape. Please join me in welcoming on stage V. Vaidyanathan, MD and CEO of IDFC First Bank, to take the stage.
Good morning, ladies and gentlemen. It really is a pleasure for us at IDFC First Bank to be at this very fantastic gathering, and we heard some wonderful speakers thus far. And Mahalakshmi and everybody who triggered such a wonderful debate, thank you very much for bringing those perspectives to all of us. Today, the key thing that I wanted to actually share with you is basically some key numbers about how the Indian credit market is growing, AIF, PMS, wealth management, and how all those numbers are coming together to position India, let me say, for the next 10 years. If you think currently there is some talk in the country at this point of time, is consumption demand slowing, is